Hello everyone, welcome back to my channel. I'm sorry that I haven't posted anything for the last couple of months. I was focused on the Portuguese channel and to develop content for both. Although it's very similar content, it's when it comes to editing, it kinda adds up. But now I'm back and I'm here to share with you my picks for this month. It's a little bit late already because some of them already ran based on the news that I was expecting this month. However, I still think they're very good picks for until the end of the year. I expect the market to continue to rally, as I said in one of the first videos in this channel, in the picks of April. But without any ado, let's get into the video. Okay, let's go for it. First pick is interactive brokers. Yes, the wave of new investors, retail investors going into the markets is ridiculously high. It's not only in the US, it's also in the EU. Although in the US, we already know through Robinhood's numbers, by the amount of social media talking about stocks and investing, the number of accounts reported not only by this Robinhood but also by Schwab, TD Ameritrade, and Interactive Brokers has been amazing. It's been the second biggest monthly add of new accounts for these brokers on history. So clearly they will make a lot of money out of this. Additionally, the average daily trades, ADT, according to Interactive Brokers, is substantially higher, which really means a very high multiplier effect on revenues. So I expect Interactive Brokers to go to 80 by the end of the year and hit new highs. Remember, it's a tech company in a sense. They do have a lot of economies of scale. It's more or less under the radar. If you want to go through options or through stock, there are many available alternatives for you to go and manage your risk. However, I think this is a very big no-brainer. I've been talking about this pick for the last 2 months, and I really do believe there is a very big opportunity right here. So for whoever's looking at this video, please consider taking a look at Interactive Brokers. I think you're not gonna be unsatisfied. Additionally, as an honorable mention related to this pick, I think you also should take a look at SIBO, because there are a lot of retail investors going with these Wall Street bets and this kind of off-balance sheet leverage through options. And these guys are one of the biggest exchanges in options. So SIBO has a lot to gain from this. They had a very big run in 2017, if I'm not wrong. However, I still believe that with this Fed central bank injection of cash in the market, that the multiples will expand, and I think that the only threat would be regulation around derivatives, restricting retail investor to this kind of access. But I think that's a long way from today, and so I think that's also a good thing that we should look on. Then my second pick for this month and for the rest of the year, in a sense, would be in a gaming industry. And yes, I've been talking about the gaming industry. In April, I made a video saying the best stock in the industry. Who was it? And I've mentioned CD Projekt Red, and in real terms, it was the only one that actually doubled since March. Activision had a very big run, a good run that I also caught, but back in last year after management compensation was fixed. It was a very good play by Bobby Kotick once again. He manages to do this every 4 years. So it's good that in the next cycle we'll be here in Activision to make money on the next run up, because Bobby Kotick really knows how this works. But right now, with CD Projekt Red at 400, I've shifted my attention to Ubisoft. Yes, Ubisoft is one of the worst when it comes to efficiency, operational efficiency. With regards to pipeline, they managed to have basically nothing during this COVID period. Now, all of a sudden, we have this out of the blue drop game called Hyperscape, which is a battle royale similar to Fortnite or the Call of Duty War or the latest mode on Call of Duty, it has its own difference. It has its own mechanics. It seemed quite interesting. Visually, it's not the kind of experience that I'm looking for, because I feel like if you're going to do such a stylized game, you should at least try to give it more FPS, which was basically what Fortnite did. So Call of Duty versus Fortnite, runs on a very high FPS basis, so it gets, although it's stylized, it's a very well polished stylized game. So it's very different. I don't know how it's gonna go. I'm not expecting anything big from this Hyperscape game. However, the guidance was not taking into account this game, and that's why the game performed as we've seen. The company stock performed as we've seen. It ran over 15% in the last 2 weeks, whatever, since the beginning of July. However, now in the 12th of July, we'll have the reveal of some of the pipeline that Ubisoft has been working on, and that should be interesting because it's going to give us a glimpse, hopefully, for the games that are coming out next year or by the end of the year to the new PS5 and the new Xbox. However, if they do not provide any kind of significant announcements, then we cannot readjust our guidance for next year, and the stock will most likely drop once again, because we need to see that Ubisoft, although they lost 2019 and they're on their way to lose 2020 revenue wise, we need to see something past 2020. Now, there was a leak of Gods and Monsters recently, and that leak clearly showed us that when they meant that the game is being built by the same developers as Assassin's Creed Odyssey, or the same studio, they actually mean reused a lot of the assets. So just like they did with Ghost Recon, where they used a lot of the assets that they previously used in the previous game, they're doing the same now, but with the stylized version, using the animations and using some of the assets to develop this new game, Gods and Monsters. Now, however, these games do have very big margins, or higher margins, where compared to a new brand new game, which this is, but it's reutilizing assets, and thus margins will be higher. However, Ubisoft has more than 10,000 employees. It's as big when it comes to employee number as Activision, for instance, although Activision sources a lot of their material from outsourcing, and they ask for a lot of outsourcing jobs, for instance, to Elite 3D in Germany. However, Ubisoft also does this, and they do have a lot of internal force to develop games, and there's no excuse that there are no brand new titles or a higher frequency of titles coming out. Yes, they do have a very big mobile lineup. However, it does not justify this 10,000 employee count head. So my point here is, even if they do not show anything or substantially past 2020 and the stock drops, it's very much likely that there are many games on the pipeline that haven't been announced, and that they're basically hitting all with a bazooka in the next generation and try to jump ahead of the competitions by having more titles, better titles, with more development time, essentially sacrificing the last 2 years. Now, you could say, yeah, but Ubisoft basically was the only company that didn't manage to make a lot of revenues or to capitalize with this COVID thing and the quarantine. Yes, indeed, they basically didn't have any game out to capitalize with this stay at home in a substantial way. However, this COVID actually enhanced the trend of games, the penetrations of games in our society, and that I feel like it's a positive all across the industry, even to those companies that never released a game, right? Because now their customer base is higher, the customer base has a higher propensity to spend, and thus even the propensity to go for subscription services, if you think it in a more broad way, that people that start with Netflix maybe or HBO during this quarantine now maybe may be more prone to services like the Game Pass or a subscription for games like EA Pass or Ubisoft Plus or whatever. So I feel like overall this is a very positive in the industry, and I feel like Ubisoft is discounted when compared to peers for several factors. Some of them I already mentioned. The other is that it's an European company. It has very big fixed structures that cannot easily reduce because of the many employee laws that we have here in Europe that most of these American companies do not have to worry about. And also because, yeah, management-wise, they could be doing better for several years. Now the same story. Yeah, so this was my second pick. I'm looking forward for your comments below to know what you think about it. And my third pick is really a global pick in a sense that it's not only one specific company. I think that dividend stocks didn't break out yet because there's a lot of focus on tech. There's a lot of liquidity going into tech. And if you get into Coca Cola, into Gilead, into 3M, yes, they are more prone to disruptions in supply chains. But valuation wise, if you talk about each case, it's its own case. But when you talk about Coca Cola, you have to know that they are in a very backline of discretionary spending, and thus I do not feel like if the income drops substantially in households, that the consumption in sodas and the pipeline that Coca-Cola has on its product pipeline, it's not going to be substantially affected. Of course, you're always going to be affected, but I think that the biggest effect that we may see is supply chain, right? That's the problem with 3M, but 3M was unfortunately enough very impacted by tariffs by the end of 2019, and all of a sudden they get also hit by supply chain management problems with the COVID, even though they're doing the masks and all this stuff. These companies are always prone to this kind of situations. But if you consider where 10-year yields are, which are right now in the US around 0.6%, in Europe they have been close to zero for the last 5 years, and now we're having Japan has been even for more time where they're even already doing yield curve control. I also think that sooner or later the Fed will also go to yield curve control. So if you look it on a relative basis, and if we had Coca-Cola trading at 60, okay, when the treasury yields, 10-year treasury yields were at 3%, and this was 1.5 years ago, I really think that we might just see when this tech run up catch a breath, we're going to see dividend stocks rallying, and they're going to rally really fast, just like tech, in my opinion. You may have some bumps here and there, but the money eventually will come back to dividend stocks, maybe at the end of the next quarter, close to dividend times, because that liquidity is going to be worth a lot of money when you have yields at 0% or close to 0%. So these three stocks, this third stock that I'm talking about, it's not really one stock, although I do have a preference, for instance, for Gilead because of the payout ratio and the way the company is run. I also like Coca Cola, Pepsi, Johnson & Johnson, Procter & Gamble. So overall, dividend stocks. I do have a special place for Hasbro, which was my pick in April in my last video, because I really like the management style, the opportunistic management style, that I also think that they most likely capitalized on the falling oil prices, and that they will continue to do so. Management already showed us that they are very much looking forward when they managed the tariffs by increasing inventories, which actually protected Hasbro against the COVID disruptions, because they basically, ahead of the tariffs, they build up inventory in the US by early putting up orders for toys. By building up this inventory in the US before the tariffs, they were actually protected not only against tariffs, but also against the COVID. Then we have oil prices going to close to zero and negative in one particular situation. in the change of the front month. I think it was March. But now we are just seeing that Hasbro, it's also doing this. It's not a change. It's almost like a new leg into digital services through Magic the Gathering, the acquisition of this of Entertainment One. Which I had no clue, but really Entertainment One and some of the IPs, Peppa Pig, if I'm not mistaken, I was really amazed when I saw the revenue streams that were arising from this kind of content. So yeah, Hasbro is also one of the companies that I think you should take a look at. Overall, I think macro-wise, this market is just not gonna stop because, as I've been saying, yeah, the central banks are now independent. They always have been independent, but yeah, as Ford would say, you can pick the customer can pick any color he wants as long as it's black. So my point here is central banks are independent, but they have to continue to print. All right, they have to continue to ease. And I see people talking in Europe that countries such as Portugal will have to go through austerity again, that these measures will skyrocket the debt of the country and the deficits. However, guys, if we do enter in this new super easing modes of all central banks around the world, and really do not understate the importance of having the three biggest central banks at zero or close to zero. One thing is having the US at 2%, all right, as the last savior. Okay, having the US go to zero, it's gonna have a ridiculously higher impact than just having the European Union. I mean, one alone, it's always like you always have some place to flee, right? So, oh, Japan goes to zero, now we're staying in Europe and the US. Oh, Europe goes to zero, fine, we still have the US, but now it goes to US, where are we going? Yeah, that's the thing. The liquidity here is the current scenario is so chaotic that I feel like this is just going to accelerate, and I really don't know where it's going to stop. So we as small investors rather ride this. Do not, in my opinion, I think we shouldn't short or try to time or try to put this market, buy puts on this market. If you want to hedge against this kind of actions by central bank because you do not agree with the policies that have been taken, rather go to gold or Bitcoin. Even though you may lose money, of course, it's an investment, it has risk. I think it's the most efficient and with less carry of hedging against the type of monetary policy and fiscal policy that has been taken. The system is building a lot of stress, and you can only continue to fight it if you continue in extreme easing. Well, we're approaching 20 minutes now. I hope you liked the content. And yeah, if you did, please subscribe, share, like the video, and I'll be expecting to read your feedback in the comment section below. Have a great evening. See you until the next video. Bye.